The Fed pivot is here, but is this actually what people are asking for? Because the end result of it is going to be something that most people haven't expected. You came here for the truth, so let me unveil that for you. The first thing we need to look at is what happened at the Fed meeting. This was something that the stock market happened to love, and I'll explain why. The second thing we got to understand is how this will impact the bond market, the economy, and of course, stocks as well. And then we need to look at why more inflation is set to occur. Yes, beyond all that we've been seeing recently, even more. Let's dig in right away. I want to show you what has happened here with the Federal Reserve and understand where we've been up until this point. You see, interest rates super low for super long, and we know that as time has moved on, we have been accustomed to that. And that has made the markets really hate everything that's been happening with these higher levels of interest. It's been a wacky time. And now what we are seeing is the final change. Perhaps right now, the Fed had this meeting, they held interest rates, and they kind of said, let's wait and see. There's more details though. There's some things you may not have been aware of. Fed leaves US rates unchanged, but long way to go in the inflation battle. Central bank maintains the benchmark Fed funds rate, but Chair Powell says he leaves the door open to further rate increases. The market didn't hear that. The market only heard you're not going to hike and you're probably done hiking. All right, let's buy it up. And so the markets did go up because in the last little while, the markets have been rather weak. And based on some technical indicators, it looks like it may have bottomed out, at least on this near-term trend. If we go into a recession, perhaps different story. But right now, short term, it looks like the markets are loving this. And for good reason, because they need the money printing to happen in order to go up further to new record highs. Here are the key takeaways. The FOMC left unanimously, by the way, left them unchanged. So the interest rate right now is at a 22-year high, 5.25 to 5.5%. They said that they would, basically repeating the prior language, of determining the extent of additional policy firming that may be appropriate. All that means, let's get rid of the Fed speak. If we need to, we're going to hike if inflation goes up higher. If inflation doesn't go higher, then we can just continue on with this level of interest rate. They're not necessarily talking about cutting rates, but they're talking about cutting rates. Okay? And the economy expanded at a strong pace in the third quarter compared with prior description of recent solid pace. And so basically, if the economy is too hot, if things are too crazy, then the Federal Reserve needs to continue to increase interest rates to slow things down. But if things are weak, well, then they have an excuse to cut interest rates and start printing money. But that's not really what's happening, based on their indicators, of course. And so we look at this in depth. The Federal Reserve has basically said, because yields have risen, the bond market, you're going to get a lot for your bonds at this time, right? You're going to get 5%. You're going to get more than 5% on some of that debt. And so that, in a sense, creates what he said anyway, was a slowing down of inflation, achieving the goals that they have. And so in part, that may mean that they don't need to increase here if that were to continue. If things change, then who knows? But the markets, let me tell you, are in a state in which, at least according to some indications, a buy right now. And that is, there's a million different ways to look at it. This is just something that I pulled up, but just showing us that we find ultimately that when there's too many bears, it looks bullish. And when there's too many bulls, it looks bearish. It's always the opposite. When everybody jumps in on a trade, oh, AI is the next big thing. Look at what happened. The peak optimism for AI came at the absolute top of the market for AI. And now we can see that has somewhat come off the top. Doesn't mean it's going to go crash to nothing. It just means that when there's too much optimism or too much pessimism, it usually flips the other way. And we can see that with different oscillators. These oscillators, I'll talk about these in my small group class on the Friday session. But basically, you have different oscillators. Stochastic, the stochastic indicators, they got the RSI, you got the stochastic slow. You have even the RSI indicator. You can look at, there's a number of them. But the point is, these oscillators tell us when we've gone overbought, when we've gone oversold. And of course, that means the opposite usually occurs. When there's too much in one trade, it usually goes the other direction, okay? We see that in the technicals, and right now, certainly that had been the case. That's short term, though. That doesn't mean longer term, even medium term. 2-year yield plunges as hiking cycle nears an end. And so the markets just said, okay, that's it. It's over. And we'll see what happens, okay? But maybe that 5% level was the top, and maybe rates won't go any higher. What do you think? Powell's dovish pivot was cheered by the markets. And of course, the S&P did go up. But when you look at what's going on in the economy, this could derail their entire plan. And that's what I'm trying to get to here in this video. What do you think is happening inside the economy now? Do you see strength? Well, when I go out, certainly people are still spending money. And it really depends, though, when you start asking questions about what people are buying and everything is, being locked up behind the counter because of so much rampant theft and all these different things. And it starts to paint a mixed picture of what's going on. But when we look at the GDP Now statistic directly from the Federal Reserve, they're telling us prior it was 5%, 4.9%. And now they're telling us it's going to be 1.2%. Okay, big change. So we know that that very unusual spike was not exactly the most realistic we've ever seen before. If we have a weakening economy, that would, in fact, create an incentive for the government to need to spend more. But when that spending happens, it comes at a price. And that's what I want to break down in these next few articles where we talk about Summers. We're going to look at Druckenmiller and others, okay? U.S. fiscal deficit is a more serious problem than ever before, according to Larry Summers. And a lot of what this is, basically, the deficit is just too high. And you've got debt. Imagine all this debt, all this funny money. And there's an interest rate associated with that. At the same time, how do you fund the deficit? Well, you have to create these little debt packages. That's the way I think of it. I think of like the debt, they take it, they put it inside a box, they put a little ribbon on the top of it, and they sell it off to investors. But that is ultimately something that has to be paid back with interest. And you can't afford that if you continue to make things worse, if you continue to go into that debt. And they're clearly doing so. And so Larry Summers is pointing that out. He's not the only one. The higher for longer concept has a really dark underbelly to it that I think has affected the bond market over the past 6 or 8 weeks. This is according to the bond king, Jeffrey Gundlach. This interest expense is starting to come home very quickly. One thing that the market has to confront is we cannot sustain these interest rates and this deficit any longer. And obviously, you've got trillions that are at levels, quite frankly, that you can't pay it back long term. All right. Now, looking at this is the Treasury details plans to step up the size of the bond sales to manage growing debt. And looking at this, when I just did a video about this recently, and I think it's really, really important to know what happens here. The government takes all this debt, they package it up, they sell it off to investors. That's fine and dandy when there's lots of investors coming through. But have you noticed something recently? I know you have. China is not the buyer it once was. It's debatable whether they're doing it through a subsidiary or what have you, but at least officially, they've been selling off for a decade. If you look at the trend line, it's basically been a decade where they've been largely selling off their debt. They've been going towards other currencies, And they've been buying up gold, and they've been using that, of course. This is, foreign exchange. They can use that to create a balance in between their currency and the US dollar. Now, understand that it's not perpetual. You cannot go into debt forever when you have the concern that maybe this is a problem and you're going to have to incentivize buyers of that debt with much higher levels of interest. So maybe 5% is not going to cut it anymore. There's not going to be enough investors to buy. So maybe it's 6%, maybe it's 7%. How are they ever going to pay that back? Of course, we know they can't. And that's when the Federal Reserve comes in to buy it all up. And do you see where that becomes inflationary? That's monetizing the debt. They do that already now, but we're talking about on a mass scale, beyond QE1, 2, and 3. Beyond it. World's safest market becomes a magnet for big investors. U.S. government debt was once among the sleepiest corners of finance, no longer. And they're just talking about what has been going on here. Individuals getting in, they're buying it up like crazy. They're making all kinds of bets with it. And that's how it works. In the financial industry, we are always going to see massive speculation in every corner. It's AI today, it's treasuries tomorrow, it's electric vehicles the day after, whatever. It's going to be something, and there's going to be a lot of these computer algorithms. You're going to find the traders getting into it, and that will create this massive volatility. And it's important to understand that this is always a factor. So, it's going to go way beyond on the upside and the downside simply because of speculation. And that's treasuries, that's AI, that's anything. And so we got to be aware of that. And as investors, we've got to position ourselves appropriately. We don't want to get in where there's hype. We want to know that there's a trend. We want to be with the trend, of course, but we don't want to get into hype. Comes at a time in which things are getting too hot. We start to trim our winnings, take that back a bit, and now we start to reassess. That's my message to you, okay? If you want to know more information, if you want to join a whole bunch of like-minded people, we have, I think, almost 1,400 people, 1,300 people in the Discord group. It's a place that people are sharing information about real estate, about stocks, about debt, about everything. I'm in there every single day. I'd love for you to join. It's totally free. Link in the description. Join us on these conversations that happen every single day. And at the same time, you get the notification for the daily video of the YouTube, so you'll never miss a notification. And of course, you'll get it all in one place. Link in the description. I'd love to see you there. Come in, say hi, and I'll reply to you. All right, Brett was talking about, this is the comment of the day. Thank you. David, please consider looking into what steps, if any, that individual banks seem to be taking to shore up their reserves and what they could mean for the overall health of banking. Yes, that's right. And right now, we can see that banks need to incentivize more deposits. Hey, we'll offer you more. But that's, of course, a challenge because that becomes expensive. And if they're not earning that on the other side, that's going to hit their stocks. If their stocks get hit, they start the layoffs. So watch out. Keep an eye on this right here. I want to thank you for your comments each and every single day. I read them all. I've been doing so for well over a decade, and will continue to do so. All right. So I want to thank you for being here. Don't forget to tune in tomorrow, each and every day. Take care.